Hello, and welcome to the latest edition of the Quarterly View from Glassy Mountain Advisors. I'm Jordan Smythe, the founder of Glassy Mountain Advisors, and it's good to have you here for this presentation. I'm going to begin by providing an overview of the stock market's performance so far in 2022, and then provide our outlook and some investment implications. In summary, stock market woes continued in the third quarter of 2022 as the issues that previously spooked investors persisted. High inflation, interest rate hikes by central banks around the world, mixed economic signals, including signs of slowing global growth, and ongoing war in Ukraine and the resulting impact on energy prices and supply chains. We think the recent volatility will continue until inflation cools significantly and the economic picture becomes clearer. In the meantime, we're looking for opportunities to invest in securities that have fallen in price and offer attractive long-term returns. After a rally to start the quarter, stocks reversed course in mid-August and declined through the end of September. The S&P 500 index dropped 4.9% in the quarter, leaving it down about 24% for the first 9 months of the year. Bonds also fell, with the Bloomberg Barclays U.S. Aggregate Bond Index off 4.8% for the third quarter and 14.6% for the year. The yield on the 10-year Treasury note rose to 3.8%, the highest since April of 2010. Core inflation has risen 6.6% from a year ago, the highest annual rate since 1982, and fears of recession in the United States and abroad have investors on edge. The U.S. Federal Reserve and other central banks have been increasing interest rates in efforts to curb inflation, and there are signs of slowing economic growth worldwide. The Chinese economy appears to be troubled, partly due to strict lockdowns aimed at controlling the spread of COVID-19 that added to supply chain woes. The war in Ukraine has also exacerbated supply chain issues and led to higher energy prices, which have been particularly damaging to the European economy. Weaker energy demand due to the slowing global economy caused oil prices to decline in the third quarter, but the recent decision by OPEC Plus to cut oil production led to another rise in prices. The current job situation is perhaps the most perplexing part of the U.S. economy, as the Fed's sharp increases in interest rates have done little to curtail hiring. The most recent report showed a slight slowdown in hiring, 263,000 jobs added compared to an average of 420,000 per month this year, but the number of jobs added was high enough to cause investors to send stocks down on expectations of more aggressive Fed rate increases to cool economic growth. The unemployment rate of 3.5% is extremely low and hardly a typical sign of recession. Wages have increased by 5% over the past 12 months, which is a large rise, but is not enough to keep up with even higher inflation. Job openings fell by 10% in August, and layoffs rose, signs that the Fed's actions to ease tight labor market conditions are beginning to work, but the signals from employment remain mixed. We expect the Fed to raise rates further as it attempts to reduce inflation to levels closer to the long-term inflation target of 2% annually. The Fed's actions will likely include at least one more hike of 0.75%, with the odds of recession by 2023 increasing as a result of these swift rate hikes. Corporate earnings rose 6.2% in the second quarter, a solid increase but the lowest growth since the fourth quarter of 2020. As the third quarter earnings season begins, we expect earnings to rise about 5 to 7%. The surge in the value of the U.S. dollar has begun to hurt domestic manufacturers and others selling goods abroad, since the stronger dollar makes U.S. products more expensive to foreign buyers, a factor increasingly cited by executives in earnings reports. The S&P 500 index currently trades for a multiple of just over 15 times projected earnings for the next 12 months, below the averages for the past 5 and 10 years, and a slight decrease from the multiple at the end of the second quarter. 2022 has been a difficult year for investors in stocks, one of those years that challenged investors' patience and discipline and bring emotions to the forefront. Each such period of falling prices is different from the last, making it hard to predict exactly what will cause stocks to rebound and when the recovery will come. It's important to remember that after each previous market drop, stocks did recover, and we expect history to repeat itself this time. Sometimes the recovery is quick and sharp, as it was after the pandemic-induced pullback in spring 2020, and other times the rebound takes longer, such as after the dot-com bubble crash. Regardless of the circumstances, stocks have come back and resumed their upward march after the pandemic, financial crises, conflicts including world wars, recessions, depression, and more, as shown in this chart of previous bull and bear markets. Despite this year's declines, stock market returns over longer term periods are still strong following several years of robust performance. This chart shows the annualized return for stocks over the past 1, 3, 5, 10, and 30 years. Most of these periods still have returns close to the long-term average of 10.2% since 1990. The lesson here for investors is that sticking with a proven strategy that is designed to do well over the long term through good and bad times in the markets is the best way to prosper. As you can see in this chart, trying to predict market returns in the short term too often leads to decisions that hurt long-term portfolio performance. Moves such as selling and sitting on cash while waiting for conditions to improve can be tempting, but they're extremely difficult to execute correctly and consistently in a way that does not lead to worse returns. Missing only a few of the market's best days, which often occur during a rebound from price lows, can significantly reduce returns. We have largely stayed the course with our portfolios since we do expect stocks to rebound. The changes we have made recently in the income portion of our portfolios included a switch to 2 exchange-traded funds to get more diversified exposure to the energy infrastructure sector and preferred stocks. The preferred stock ETF also provides more liquidity than individual preferred stocks. We continue to keep our eyes open for more opportunities to buy securities that are attractively priced now due to the downturn and offer strong long-term appreciation potential. Thank you for taking the time to join us. We hope you enjoyed this presentation. We welcome your questions, comments, or suggestions as always, and we hope you stay safe and healthy. Take care.